Hi, welcome to Lecture 10, covering Chapter 10 of Focus on Personal Finance. Tonight we'll be looking at financial planning with life insurance. I know a lot of people have a hard time thinking about what might happen if they pass away. I know that my mother-in-law refuses to talk about it on any level. It's difficult to stop and think about our own mortality and what would happen if we departed this earth and left our loved ones behind, especially those that are financially dependent on us. What would that look like? And how can we continue to provide for them when we're no longer here? So even though it can be a difficult topic to talk about, you have to stop at some point and ask yourself, do you need life insurance? And if so, how much life insurance do you need? Life insurance can be very expensive and a big part of your financial commitment for your insurance budget. So you want to make sure that you have all the information you need to make the right choice for you and for those who depend on you financially if the unthinkable ever happens. So in this chapter, we'll talk about the meaning of life insurance and describe its purpose and the principle. We will look at the 4 general methods for determining the amount of life insurance that you need. Next, we'll look at the types of life insurance policies, which include term life, whole life, limited payment life, adjustable life, and universal life. Then next, we will focus on major and important provisions contained in the life insurance contract. We'll emphasize the need for comparing life insurance policy costs and examining a policy before and after purchase. And then we'll conclude this evening by looking briefly at annuities. So let's get started by reviewing our learning objectives this evening. Learning objective number 1, define life insurance and determine your life insurance needs. Life insurance protects the people who depend on you from financial loss caused by your death. It's that simple. Sometimes trying to figure out exactly how much that is, it can be a little bit trickier. So learning objective number 2, distinguish between the types of insurance companies and analyze various life insurance policies. So 2 types of insurance companies are stock and mutual. These both sell non-participating and participating policies, and we'll look at those. They both also sell whole life and term life, and those are important terms that we'll look at this evening. Learning objective number 3 is to select important provisions in life insurance contracts and create a plan to buy life insurance. So most life insurance policies have standard features. An insurance company can change the conditions of a policy by adding a rider to it. We talked a little bit about riders last week. Before buying life insurance, consider all your present and future sources of income, then compare the costs so that you can make the appropriate choice for you. Learning objective number 4, recognize how annuities provide financial security. An annuity pays you while you live, where life insurance pays when you die. With a fixed annuity, you receive a fixed amount of income over a certain period or for life. With a variable annuity, the monthly payments vary because they are based on the income received from stocks and your other investments. So let's begin by looking at learning objective number 1. We want to define life insurance and determine your life insurance needs. Life insurance. Well, a person joins a risk-sharing group by purchasing a contract, which is basically a policy, and then the insurance company promises to pay a sum of money at the time of the policyholder's death in return for the insured's agreement to pay at a sum of money periodically. So basically you're making monthly payments, paying your premium on your policy, and then in that contract they agree to pay you a lump sum amount should you pass away while you're a policyholder. And once again, the purpose of life insurance is simply to protect those who depend upon you for their financial security. The trick is that you have to have the life insurance policy at the time that you pass away, and none of us know when that's going to happen. They do, however, have what are called mortality tables from records covering many years and including millions of lives. Mortality tables have been prepared that show the number of deaths for various age groups during any given year. So if you will look at your book on page 322, you'll find a table there that is a life expectancy table. This is not sorted out by race, but it is sorted out by gender, looking at male and female. And then basically what it's telling you is at any given age, how many more years are you expected to live? So just very simply look at the very first one, which is age 0. For a male, it's 76. And for a female, it's 80.9. So that's how many years that you're expected to live from the time that you were born. The insurance company then uses this table to help them to determine what your premium should be based on what your life expectancy is. It basically provides the odds of when you will die based on your age and your sex. Then your premium cost is based on what your life expectancy is and what they would project that they would pay out for a person who might pass away. And you need to ask yourself is, do you need life insurance? If you have people who rely on you for their financial income, then the answer to that most likely is yes. Or if you're single and you have lots of debt, or if you have parents or relatives or a charity that you would want to support. There are 4 general methods for determining the amount of insurance that you might need. There's the easy method, the DINK method, the non-working spouse method, and the family method, and we're going to look at those. So the first one is the easy method. A typical family will need approximately 70% of wage earners' salary for 7 years before the family can adjust to the financial consequences of the earner's death. So you need to plan on 70% of your income over a 7-year period, and this is assuming that you have a typical family. Now the DINK is double income, no kids. If you have no dependents and your spouse earns as much or more than you do, you have very simple insurance needs. All you need to do is to ensure that your spouse will be able to pay for any expenses that would result of your death, which would normally be to cover funeral costs and then half of whatever debt has been left behind. The next method is the non-working spouse method. To estimate how much life insurance a homemaker should carry, multiply the number of years before the youngest child reaches 18 by $10,000. And this would give you the amount of life insurance that you would want to carry on a spouse who does not work outside the home and earn income. And then the fourth method is designed to be a little bit more tailored toward a non-typical family. So the first 3 methods assume that you and your family are typical and ignore such factors as Social Security and rate of return on money that you may leave behind, which will impact what you actually need to purchase in additional life insurance funds. Objective number 2 is types of life insurance companies and policies. So there are 2 types of insurance companies. The first one is a stock life insurance company, which is owned by stockholders and generally sell what's called a non-participating policy. The other type is a mutual life insurance company. They're owned by their policyholders and they usually sell what's called a participating policy. In regards to which one offers the cheapest policies, there's been a lot of long and inconclusive debates on whether stock companies or mutual companies offer the least expensive insurance, and we don't have a conclusion to share with you. So you will have to make your own conclusion. I'll say that 95% of all policies are stock shareholder policies. Are stock life insurance policies, which are then owned by the shareholders. So the way that this works is you pay the same premium each year. This differs from mutual life because with mutual life you pay in a certain amount every year, and then part of the premium is refunded to you as the policyholder in the form of policy dividends. Look at the different types of life insurance policies, and there is a chart at the bottom of page 326 in your book, and you might want to just have that open and follow along to help you with your understanding of the comparisons between these. We'll begin by looking at term life. So term life insurance is protection for a specific period in time or for a term of time, usually 1, 5, 10, 20 years, depends on what your policy is, usually up to the age of 70. And then once you hit the age 70, normally term life is, it ends. You can't get a term life insurance policy once that you're past that age. There are many different types of life insurance policies that are term, and you just need to know what it is that you're buying and know what your terms are. Global term means that after your specified period of time, you can renew the policy. So let's say that you buy a term life policy for 10 years. Then at the end of the 10 years, you're able to renew that policy. However, because you're older now, you can expect to pay a higher premium. A multi-year level term is just that. It means that your payments are going to be level or even for the time that you hold your policy. They won't be increasing. Conversion term allows you to do just that, to convert your policy from a term policy to permanent coverage, but you're going to have a higher premium when you do that. Term policy actually pays less out to the beneficiary as time passes. That's based on the theory that as time goes on, there may be less expenses or less debt that needs to be paid off. And then a return of premium is fairly recent. Insurance companies just began selling these policies. They return all of your premiums if you survive to the end of the policy term. However, it has a higher price, but you do get all of your money back. And type of permanent life insurance is straight life. I've always known it as a whole life insurance. You'll pay a specified premium each year for as long as you live. The amount of premium that you pay depends on how old you are at the time that you take out the policy. So there is motivation to keep your policy, because if you would end it and then take it out again and you're older, you're going to pay higher price for your insurance. It also has a feature where it allows you to accumulate a cash value, and you can actually receive that cash value if you give up the insurance. But make sure that you look carefully at the rate of return that your money is earning with these types of policies. Different types of whole life insurance, but we're going to just look at the two most popular. And the first one is limited pay policy. With a limited payment policy, you're going to pay your premiums for a stipulated period, but then you will remain insured for life once you hit the end of the time period, so 20 years or 30 years, or until you reach the age 65, and then your policy is paid up and you remain insured for life. There's also variable life policy. Values of this type of a policy will fluctuate, but there is a minimum death benefit guaranteed. Looking on at additional types of whole life policies, there's the adjusted life policy. This policy gives you the flexibility to make changes in the policy as your needs change. Finally, there's universal life. It combines term insurance and the investment elements, and universal life is actually a little bit more flexible version of whole life insurance. So life insurance policies are group life insurance. That's actually a term policy that covers a large number of people under a single policy. So normally that's what you find provided by your employer. And one of the good side of benefits of this is that normally there's no physical required. Oftentimes for these other insurance policies that we're looking at, they do require a physical. There's credit life insurance, which is used to repay a personal debt should the borrower die before doing so. So whenever you take out a home mortgage or buy a car or furniture, you can take out credit life insurance. It's very expensive coverage, and this is one of those that I would toss out the red flag and tell you this is really designed to protect the lender rather than you as the person who's borrowing the money. And normally you can get better coverage for your dollars by choosing something that's not tied to like the debt of a particular thing like your home. So if you want to have enough life insurance to pay off your home should you pass away, my advice would be to look at one of these other types of life insurance policies and just take out a policy that would pay off your mortgage should you pass away, rather than buying credit life for your mortgage or for your car or whatever. Then finally, there's endowment life insurance. This provides coverage for a specific period of time and pays an agreed upon sum of money to the policyholder if you're still living at the end of the period. Chart in your book on page 328, and I think that you'll find this very helpful in comparing the different types of life insurances, the major types of life insurances, and what some of their advantages and disadvantages are. Moving on to learning objective number 3, select important provisions in life insurance contracts and create a plan to buy life insurance policy. Before buying a policy, you need to decide who is going to be your beneficiary. So you need to name your beneficiary, which is the person who is designated to receive your life insurance proceeds should you pass away. If the policy that you are looking at has an incontestability clause, this protects you because it says that basically after a period of time, which is usually about 2 years, the company can't dispute the validity of the policy and refuse to pay for any reason. So even if there was something that was fraudulent in the policy after a period of 2 years or whatever the time that's stipulated in the contract, they have to honor the policy. You need to know what your grace period is for late payments. So if you're a couple of days late, you want to make sure that you're not losing your coverage. Typically, it's about a month, 28 to 31 days that they allow as a grace period, but you want to make sure that you know what that period is because after that time they can cancel the policy and not honor it. And then you also need to know what the reinstatement clause is. So basically, if you for some reason do cancel or have your lapse in your policy, can you reinstate that if you've not been paid any cash benefits? What is the stipulations for being able to reinstate that policy? Of a whole life policy is the non-forfeiture clause, and this clause prevents the forfeiture of accrued benefits if you choose to drop the policy. There is a misstatement of age provision. If the company finds out that that the insured person's age was incorrectly stated for whatever reason, it will still pay the benefits that the insured premium would have bought if the age had been correctly stated. So your policy loan provision, how long does the policy have to be in effect before you can borrow against it? Most policies also have a suicide clause during the first 2 years. The holder would take their life during that time period. All that they would get would be the amount of the premiums that they paid in and not the amount of the policy purchased. And we talked a little bit about policy riders last night, but this is just a document that modifies the coverage by adding or excluding conditions or by altering benefits. Buying your life insurance policy, you want to consider your needs in light of what is your present and future sources of income, what are savings that you have, any income protection that you have, group life insurance, group annuities, Social Security that you would qualify for. You want enough coverage without being overinsured. And this was something I neglected to mention last week and in looking at health insurance, and it goes with life insurance as well. Sky is the limit. You can buy as much coverage in health and life insurance that you want to carry, but what you don't want to be is insurance poor. So you need to adequately evaluate what are your needs and then find policies that fit with what your needs are, because otherwise you can spend a very large percentage of your income in insurance that is really not practical, is more than what your family actually needs or you. We looked at this last week as well. Who do you buy insurance from? Life insurance, it's the same thing. You want to buy insurance coverage from financially strong companies with professionally qualified representatives who know what they're doing. Make sure that whenever you're taking advice from an insurance company or insurance salesperson, that they have experience and know what they're talking about. It's always great to help a friend get started, but you need to make sure that you're getting the best policy and the best information to best serve your needs, because this should be a long-term commitment when you purchase life insurance. So make sure that you check out ratings on major companies as well. And just like we talked about last week, you definitely need to do some price shopping whenever you're looking for a policy. So make sure that not only the policy fits you, but you've also done your homework on the price that you should be charged. Because the price of life insurance policies vary. They vary considerably among life insurance companies. And you also need to ask your agent to give you what's called an interest adjusted index. which is a method used to evaluate the cost of life insurance by taking into account the time value of money. So the lower the index, the lower the cost of the policy. Should you be prepared to take when purchasing a policy? Well, first of all, you're going to need to apply, which is going to require you to do paperwork, and it is going to ask for medical history. Once again, if it's a group policy, there's usually no physical, but if it's not a group policy through your employer, you should be prepared to be asked for a physical. Read every single word of your policy contract. Make sure that you understand, and if you have any questions, you need to ask your agent what that means, or look it up in this book that you have purchased for this class. Keep this book because it'll be a great resource to you as you go through the steps on a lot of the things that we've talked about. Then finally, don't forget to give a copy to whoever you have named as a beneficiary, and then also your lawyer. If you have a safety deposit box or a safe in your house, I also recommend that you put a photocopy of the policy there. Brings us to our fourth learning objective for this lecture: financial planning with annuities. An annuity is a financial contract written by an insurance company to provide you with regular income. As a general rule, annuities are not advisable for persons with poor health. An annuity actually protects you against the risk of outliving your assets. It can supplement your retirement income and also give you a shelter from taxes. But you need to fully fund your IRAs, your 401ks, and your KIOs before considering an annuity. Prime reason for buying an annuity is to give you retirement income for the rest of your life. The compounded interest on your annuity grows tax-free until you actually withdraw the money. There's no maximum annual contribution like you have to do with an IRA account. And at the very minimum, your beneficiary is guaranteed to get at least what you have paid not in premiums, but in payments. Will pay several charges when you buy a variable annuity, and you need to be aware of what these are. The most common are surrender charges, mortality and expense risk charges, administrative fees, and fund expenses. These costs will reduce the value of your account and the return on your investment. Conclude by looking at the tax considerations of annuities. The interest on the principal, as well as the interest on the compounding of the interest, builds up free of current income tax. With an annuity, there is no maximum annual contribution. It is exhibit number 10.6 and can be found on page 340 of your book. It depicts the difference between an investment in an annuity and then if you would invest in a CD. So the CD is the maroonish purple color, where the annuity is the teal blue color. And though the annuity looks very attractive, I do want to remind you that there are the drawbacks that we covered that reduces the flexibility of and fees that lower your investment return. As a reminder, the full set of these PowerPoint slides have been posted for you, as well as a few supplemental videos that I hope you'll take a minute to review. And as always, I'm available to you should you have questions or comments. And I look forward to speaking with you shortly.